Good afternoon to everyone attending from the East Coast, and good morning to people who've joined us from Western Australia. We will look at some recent changes in FPT that applies to the current FPT year. Here are the relevant rates and thresholds for the current FPT year so that they are easy for you to find. We will not go through them individually, but a few things to note is the significant increase in the benchmark interest rate and the introduction of a cents per kilometer rate for electric cars, which we'll cover in the later slides. We'll now look at some recent updates. Electric cars has been a favorite topic in the FPT space in the last 2 years. Just to refresh our memories, electric cars are not subject to FPT from 1 July 2022 if certain conditions are satisfied. To access the exemption, the electric vehicle must meet the definition of a car under the FPT legislation. So the exemption does not apply to motor vehicles, e-bikes, or vehicles designed to carry a load of greater than 1 ton. It must be a battery electric vehicle, hydrogen fuel cell vehicle, or a plug-in hybrid car, and the price must be below the luxury car threshold for that year. It is important to understand that not all portion of a car's cost is included in the calculation of luxury car threshold. Costs such as stamp duty, service plans, and finance charges are not considered for luxury car threshold purposes. So here is an example of a car costing more than $92,000, still qualifying for the FPT exemption, as the cost only includes the GST inclusive price for luxury car purposes. For many electric cars these days, you can upgrade a lot of software after you've purchased the car. If you did so, anything after you pay afterwards does not get included in the cost of the car for luxury car tax purposes. We will now launch a poll question. I know that FPT implications of an electric vehicle is a very new concept, but have a go at answering this question. For FPT exempt electric vehicle, do you need to worry about including recipient's contribution in the calculation? We'll give you 5 seconds to answer that question. So for those of you who've answered yes, please pat yourself on the back. You need to factor in recipient's contribution as they will reduce the reportable fringe benefit amount on an employee's income statement. Notwithstanding the fact that the vehicle is exempt by itself, it still needs to be reported for RFPA purposes. The ATO has issued a practical compliance guide which provides a 4.2 cents per kilometer rate for using electric cars when they are charged at home. If you have outright purchased the car, you can use this rate to claim a reimbursement for work-related reuse of your car or a tax deduction in your personal tax return. Where your car is obtained under a novated lease arrangement or it has been provided by your employer and you seek a reimbursement from your employer, you can use this rate and the reimbursement will not be subject to FPT. If you don't seek a reimbursement, you can calculate an amount using this rate, and this will be your employee contribution or the recipient's contribution, which will reduce your reportable fringe benefit amount. Now, any in-home charging equipment is a separate benefit and will be looked at either as an expense, property, or a residual benefit. Records such as logbooks and odometer readings will need to be maintained in order to use this shortcut method. Now, this guideline only applies to cars and no other vehicle type. So if you've got any other vehicle type that is an electric vehicle, you cannot use this rate. We will now launch a second poll just to get you guys thinking about employee contributions. So when preparing the FPT return, how do you calculate the recipient's contribution for an electric car, given the car is largely charged at home using rooftop solar? A, cash contributions made by the employer. B, cash contributions plus any servicing costs plus commercial station charging expenses incurred. C, cash contributions and ATO cents per kilometer ride. Or D, all the above. Okay, so those of you who answered D, that is the correct answer. You can claim a recipient's contribution. Anything that an employee has paid is counted as a recipient's contribution. The next topic relates to a pain point that everyone who's involved with collecting declarations may have experienced: employee declarations. Now, employee declarations are required to reduce the taxable value of benefits for various concessions, and these must be collected before the lodgement due date of the FPT return. Currently, there are 20 declarations prescribed by the ATO on their website. Now, the Commissioner has acknowledged that some of these declarations are doubling up on the record keeping that you already maintain. Last year, the Commissioner had issued about 10 draft legislative instruments for various benefits, which provides that the employers don't have to obtain employee declarations if sufficient information is obtained from alternative records. Three of these legislative instruments have been finalized and 7 are still in draft and are expected to be finalized soon. However, if taxpayers want, they can start to rely on these early. There is no prescribed number of records or the type of alternate records from which the information should come from. The information can come from any number of records. Some examples of alternate records, acceptable alternate records, include employment contracts and relocation agreements that provide employee details, expense management system, which can provide relevant dates, for example, dates when temporary accommodation was required, or lease contract information in relation to relocation benefits. Payroll systems can have, for example, LAFA applications built into it, in which case details around usual place of residence may be available from that. Mobile logbook apps or fleet registers can provide information around usage of vehicles. Access to Outlook records can provide information that can replace travel diaries in some instances. Not sure how many people would feel comfortable in giving their finance team access to their Outlook records, but look, this option is available. The records, the ATO says, can be stored electronically or in paper format and can only be accepted as an alternate record keeping in place of declarations if they are obtained and held by the employer by the employer's declaration date, which is the lodgement due date of the FPT return. So practically what this means is you have to have all these alternate records available in place before the lodgement due date of the FPT return. You cannot be preparing the FPT return and relying on these things as you make up for it. The next one is the new tax ruling on deductibility of self-education expenses. Now, the ruling reflects the removal of the $250 non-deductible threshold. Self-education expenses are tax deductible and as such considered as otherwise deductible for FPT purposes where the expenditure relates to a person's income earning activity. Whilst the ruling does not introduce any new or significant concepts, it provides lots and lots of examples for greater clarity. Some of the examples around travels and meals in relation to self-education were overly simplistic in my view, and the ATO could have provided more detailed and realistic examples, real life scenarios, but there are many examples in there. The ruling also clarifies that repayment of indexation of a HELP loan is not deductible. The two principles that are outlined in the ruling for deductibility are the expenses should relate to maintaining or improving the knowledge or the skills of the employee, And the knowledge or the skills obtained should not be too generic. Otherwise, they will not be a sufficient connection with the income earning activity. And the expenditure has the necessary connection to your income earning activities. The second principle is that the expenditure should objectively lead to an increase in income from your income earning activities, from your current income earning activities. In addition, there are two exclusions. It should not it should not be there to open up new employment opportunities for you and should be incurred whilst you continue to undertake income earning activities. So the key takeaway there is if your organization's internal training and education policy has not been looked at in the last 4 or 5 years, you may want to review it to ensure they align with the draft, with the ruling that the ATO has issued for self-education. Now we will go through some FBT benefits, the basics of FBT for some common benefits. First one is cars. Now for a car fringe benefit to arise, a car has to be owned or leased by the employer. There is a specific definition of a car within the FBT legislation which says it's a motor vehicle designed to carry a load of less than 1 ton and fewer than 9 passengers. And it does not include goods carrying vehicles, even if they are designed to carry a load of less than 1 ton or fewer than 9 passengers. For example, single cab vehicles. Now, electric car exemption applies to the following cars: battery electric cars, hydrogen fuel vehicles, and plug-in hybrids. And plug-in hybrids, it's until 1 April 2025. There are other conditions that need to be satisfied as well for electric vehicle exemption. It has to be first held and used after 1 July 2022, and it should be below the luxury car threshold for that year. Electric motor vehicles and scooters do not qualify for this exemption because they do not fall within the definition of a car. Now, there are two ways to calculate the taxable value of a car fringe benefit: the statutory formula method and the operating cost method. Statutory formula, it's a very simplistic formula. You calculate the base value of a car, which includes the GST inclusive cost of the car. There are a lot of portions of the purchase price of a car that do not get included in the base value, for example, stamp duty and registration fees. You multiply the base value of a car with the statutory percentage, which these days it's flat 20%, and apportion that with the number of days the car was available for private use. And finally, you reduce it with employee contributions. Now, these employee contributions, which go towards reducing a taxable value of a car, should be after-tax employee contributions. Operating cost, you total up the operating cost of the vehicle, which includes deemed depreciation and interest if you own the vehicle. Multiply that by the percentage of private use and take off any recipient's contribution. Here are some PCGs, practical compliance guides, that can be relevant for this year. The first one is in relation to motor vehicles other than cars, where you can use the Commissioner's Safe Harbor to assess whether a car's use qualifies as minor and infrequent. This is for motor vehicles other than cars like dual cab and single cab utes. The second one where you are unable to obtain all the logbooks in a fleet of vehicles, then you can use the average business use percentage provided you satisfy some conditions. And the last one is for cents per kilometer rate for an electric vehicle. Next one's car parking. Now, for a car parking fringe benefit to arise, it has to be a car which has to be parked at the premises owned or leased by the provider, which is the employer. So if I lease a car park in Secure or Wilson's and Charming pays for it, it would not qualify as a car parking fringe benefit. It has to be leased or owned by Shinewing. The car should be parked within the vicinity of the primary place of employment, has to be parked for more than 4 hours between 7 a.m. and 7 p.m., and should be used for travel between to and from work and home at least one day during that day. And a commercial parking station should be available within a 1 kilometer radius of where the car is parked that charges more than the daily threshold prescribed by the commissioner for that year. Now, the commercial parking station's presence is very important to trigger a car parking fringe benefit. Now, historically, the ATO had accepted that a car park that had a free period or a low hourly rate but imposed a penalty rate for all day parking was not deemed to be a commercial parking station. This generally applied to most shopping centers and hospitals' car park. However, following the Qantas and the Virgin cases, the ATO has released a tax ruling 2021/2, which significantly broadens the definition of a commercial parking station and now includes shopping center and hospital car parks as commercial car parks for the purposes of car parking fringe benefits. The ruling provides that the employers are required to determine and reasonably conclude whether a car parking facility is present within a 1 kilometer radius by applying some tests in that ruling. Now, there are two methods to calculate the taxable value of a car parking fringe benefit. Take a step back. There are two parts to calculating the taxable value of a car parking fringe benefit. One is the calculation of valuation rate, and the other one is the calculation of annual taxable value. For calculating the value of the car park, there are three methods available: commercial parking station, market value method, and an average cost method. Commercial parking station is you look at the commercial parking station within a 1 kilometer radius and use the rate charged by that one. Market value is when you got no comparable parking stations around the premises to decide what the rate should be. Then you go and obtain a formal valuation. And the average cost method is the average between the opening and the closing rate, and you decide the daily rate for the car parking fringe benefit calculation. The second part is calculation of annual taxable value, which you've got three options again. 12-week register method, where you maintain a register for 12 weeks to work out the pattern of use of the car park and use that percentage. Stat formula method, which uses a flat truth, which assumes that the car parking was available for 228 days of the year, and the actual method where you keep a record of when the car parking was used. Some common exemptions available to car parking fringe benefits is parking for disabled persons is not subject to car parking fringe benefit. Small business car parking exemptions, if you qualify as a small business, which means your turnover has to be less than $50 million, then you are not subject to car parking fringe benefit if you satisfy certain other conditions. And parking provided by registered charities. Next one is entertainment. Now, what constitutes entertainment for FPT purposes is an entertainment that has been provided by way of food, drink, or recreation. And any accommodation or travel in connection with it or to facilitate that is also considered entertainment. We have to be careful between distinguishing between meal entertainment and other entertainment facilities because there are different valuation rules that apply to each of them. Now, not all provision of food or drink is considered entertainment. For example, sustenance, anything spent for coffee and a sandwich would ordinarily not constitute entertainment. Meals whilst traveling overnight for business should not be considered as entertainment. Light meals under $15. Any meals provided around eligible seminars which go on for more than 4 years should not be considered entertainment for FPT purposes. And there is a concession in an old tax determination which says if you got appropriate advertising around corporate boxes, any amount spent on the corporate box entertainment, you can attribute a certain percentage as not subject to entertainment fringe benefits. Now, there are a few methods to calculate the taxable value of entertainment benefits. There's actual, in which case no election is required. You work out what the actual costs are. 50-50 split method and the 12-week register method. Now for 50/50 and 12-week register, you need to make an election. And if you've got salary package entertainment benefits, you only allowed to use the actual method. Now there are some exemptions available. One of the key ones is minor infrequent. Important to remember here is there's a $300 threshold, plus there is an infrequency and an associated benefits test as well. So the entertainment has to be provided infrequently, and when you are assessing it, uh, whether it's exempt under the minor benefits rule, you have to look at associated entertainment benefits as well that have been provided during the year. Now, portable electronic devices, just very quickly on this one, they are exempt provided you meet certain conditions. Being primarily intended for work use, should be light and portable, capable of being used away from an office environment, and can operate without a power supply, external power supply, and is designed as a complete unit. Common examples: mobile phone, laptop, printers. And there is a restriction of one item per FPT year for substantially identical for devices which have substantially identical functions, unless it's a replacement device or the business qualifies as a small business. We have put some items here to get that we get frequent questions about. First one's earpods, whether it's an portable electronic device. Yes. Substantially different in function to work provided device. Most of us get work provided device when we are working from home. Is the earpod substantially different? I guess no. Primarily intended for work purposes. This will depend on your personal circumstances, but generally you would say no. Next one, smartwatches. Smartwatches, there's an ATO tax ruling in which the ATO has said the smartwatch has a similar function to that of a mobile phone. However, because of some of its inbuilt functionalities, it can be argued that it is got functions that is different from a mobile phone. So it does qualify as a substantially different function to a mobile phone. Whether it's primarily intended for work purposes is a question you need to decide, whether it's a requirement of the job to have a smart watch on the employee's hands. Apple Pencils, yes, it is a portable electronic device, but it's not designed to be operated as a complete unit. It must be paired with an iPad before it's used, so it does not qualify as a portable electronic device. Just a recap on administration. Look, declarations should be obtained prior to lodgement of the FPT return and should be kept on file for at least 5 years. Motor vehicle policies and travel policies should be updated regularly. In terms of salary packaging, you should and providing benefits, you should always assess which one's a financially better outcome depending on the person's effective tax rate. RFPA excluded benefits should not be included in the employee's income statement. For example, car parking, pool vehicles, and meal entertainment that are not salary sacrificed. And use of an FPT software should always be considered as an option because it's quite helpful. It provides some good calculations behind the scenes, checklists, declarations, inbuilt RFPA. Our CTS plus FPT software have got all these functionality in addition to being able to electronically lodge the FPT return. We are waiting for the ATO to finalize the 2024 stationery and then can release the software.